Welcome to ETF Battles. I'm Ron DeLegge. A brisk IPO marketplace in the face of coronavirus. I'd say that's been one of the more surprising developments of this year. There's been 184 initial public offerings thus far, which is a 25% increase from last year. And our timing couldn't be better because today's skirmish is between two IPO-focused ETFs. We've got the Renaissance IPO ETF, that's ticker symbol IPO, against the First Trust U.S. Equity Opportunities ETF, formerly known as the First Trust U.S. IPO Index Fund, that's ticker symbol FPX. Which of these two IPO ETFs is the better choice? We're about to find out. Now, before I introduce our judges, be sure to subscribe to ETFguide TV, and don't forget to check out our new weekly series, the Portfolio Report Card, where I analyze and grade your investments. Now, helping us to judge today's IPO showdown is John Davi at Astoria Portfolio Advisors and Mike Akins at ETF Action. Judges, great to have you with us.
Good to be here, Ron.
Great to be here, Ron. Thanks.
So we've got our 4 battle categories, and as you can see, my battle scorecard is ready, and it's blank, which means that we're going to fill it out as we go along. We've got cost, exposure, strategy, performance, and then our mystery battle category where you guys get to pick that one factor or several factors that you believe are crucial to today's battle. And each of you are going to have 30 seconds in each category. Then we'll declare an overall battle winner at the end of the show. It could also end possibly in a split decision. We'll just have to see. We're going to start out, though, with the first category. And John, you're going to go. This is cost. Who wins the battle?
So cost, I would say FPX wins marginally. It's 2 bips cheaper. It's 58 basis points. IPO is 60 basis points. You know, as we've talked about on the show a number of times, I think you got to look past that. You got to look at exposures, you know, the actual index methodology that underlies an ETF. You know, there's some pretty different things that going on between both of these IPO ETFs. So I'm looking forward to going into the other categories. But for now, just slight edge to FPX, which is 2 bips cheaper, 58 versus 60 basis points.
All right, that's a strong start. Mike, how do you see it in terms of cost?
Pretty much in complete agreement with John on this one. It's toss-up on cost. They both provide access into a unique area of the market, but in very, very different ways. So cost should have no real bearing on your decision process between these two strategies.
That takes us next to the exposure strategy. Mike, you're still up. Who wins the battle?
Oh my, where to begin? There's some big differences here. So let's just start understanding, you know, these both are passive strategies. They follow an index. So you got to think about when at ETF Action, when we categorize ETFs, we break down strategy and weighting. Weighting is pretty similar for both these strategies. So we can focus in on that selection methodology. We refer to that as strategy. And here is very different. So first and foremost, IPO looks at companies that have IPO'd in the last 2 years and specifically initial public offerings. FPX actually owns recent issuances, and that is different than an IPO in that it holds it for 1,000 trading days. Roughly 4 years is 1,000 trading days. So very different time frames on how long they hold those strategies. And they also include secondaries, spin-offs, different corporate action things that will end up, and we'll get into this a little bit when I talk about my mystery category, we'll end up with a lot of companies you would not think of in an IPO ETF. That results in portfolios that are significantly different. I believe that both of these strategies are what I would fit in my expand box, ETFs you use to expand your portfolio. On that topic, on that concept, I give the win to IPO for their methodology every day of the week and twice on Sunday.
All right. And 3 times on Monday.
3 times on Monday.
Very good. Let's shift to you, John. How do you see it in terms of your exposure strategy? Which of these 2 ETFs is the better play?
Well, if you want pure IPOs, then IPO is the ETF that you're going to want to buy. FPX, as Mike said, it's got a lot of other stuff in there. It's not really intuitive to me why you'd want to buy, you know, secondary offerings or issuances. So IPO wins on that front. You know, we are big users of ETF Action, Mike's tool. So, you know, when we look at it, there's only 25% overlap between the two. If I just short on, you know, the largest names in FPX, I see Snap, Thermo Fisher Scientific, Uber Technology, Marvel Technology, Fidelity National Information Services. These are all between 4 to 8% of FPX. I actually don't know a few of those companies, so maybe those are the offerings that Mike talked about. If I just sort by the IPO ETF, you got Zoom, which is 10%, Uber, which is 10%, Pinterest, which is 7%, CrowdStrike, which is 6%. So these are all, new IPOs, what you hear and see about on TV a lot. So very, very different makeup, more intuitive to me to look at IPO. But, hey, FPX has about $1 billion in assets. It's been around since 2006. I'm pretty sure they've rebranded this. I've known the creator of this product, and back in the days, I think it was just pure IPOs, and they subsequently changed the methodology. So a little bit of history there for you. But IPO wins just purely on its exposure to IPOs.
All right. You guys both agreed on that battle category. Next up is performance. You're still up, John. Who wins the battle in terms of performance between IPO and FPX?
So year-to-date IPO is up 83%. FPX is up 35%. So pretty healthy outperformance on a year-to-date basis. Even on a one-year basis, IPO is outperformed by about 50%, and then on a 3-year by about 10%, and then on a 5-year by about 4%. So, the longer the time period, the more they converge, which is interesting. And maybe that has something to do with, the 4-year period that FPX will allow a company to stay in their ETF, whereas the IPO kicks it out after 2 years. When I think about an IPO, I think about a very new publicly traded company. I think about a very short-term time horizon. After a couple of years, I don't think of a company as an IPO. I think of it as, a new secular growth stock or, an emerging company. So I give the edge to IPO on performance.
All right. Very good. Thank you. And we're going to shift to you, Mike. How do you see it in terms of performance between these two ETFs?
Yeah, I think John kind of hit the nail on the head with his analysis there. IPO, just from a straight performance perspective, has significantly outperformed. And the rationale for the outperformance has been because the IPO market has been hot and it's done really well. That can turn over. So if the IPO market cools off, we have a significant pullback, I would expect IPO to go down more than FPX. But if you're thinking about why you're owning one of these strategies, it's to get an allocation to companies that you probably don't otherwise have in your core portfolio. And from that perspective, I believe IPO is doing a much better job capturing that trade for you, and it's doing it in a much shorter time frame. So there's much more applications for IPO in a portfolio, in my opinion, than FPX. So I'm going to give the nod on performance to IPO, both backwards and forwards looking.
Our mystery battle category is next up, and you're still up, Mike. Who wins the battle in terms of your mystery category? Tell us what is your mystery category and who wins it?
Well, you know me, I like to get under the hood. I mean, at the end of the day, ETFs are just the sum of their parts. So if we look at the parts being the companies that they own, I think people would be surprised to know that only two companies that are in the top 10 of FPX are also in the top 10 of IPO. That's Uber and Zoom. The other 8 companies inside of FPX are Snap, Thermo Fisher, Marvel, and John went through these, Fidelity National Information Services, Eli Lilly. These are companies that I don't think people would necessarily put in mind with the IPO market. Snap, a little bit more so, but that's, it's been out since 2017. So whether it's still considered recent IPO, I think's in question. So it really just comes down to that underlying holdings, and that in this case, it's a stark example of how two very similarly stated investment objectives of ETFs can be completely different based on methodology. And it's a great example looking at these two ETFs to understand that.
Yeah, great points. Let's shift to you, John. What is your mystery battle category and who wins it between these two IPO-focused funds?
My category is the index methodology, which we've already talked about at length. You got to really know what the underlying rules are and the criteria. And, for all the reasons we've been talking about, Mike and I, it's hard for me to understand why FPX would have, secondary offerings or some of the stocks that, that Mike just mentioned, in the ETF, Eli Lilly, Top Holding, so just to me, if you want IPOs, you buy IPO. It's not really intuitive to me, some of these other reasons for why you'd want to own secondary offerings. So I think index methodology, you really got to understand what's the rules that govern the ETF. And to me, IPO wins that category.
All right. Now we're going to shift to our overall battle winner. And you're still up, John. So who is your overall winner between these two IPO ETFs?
I think for a myriad of reasons, IPO is the winner. It's got more concentrated holdings, which I like, because when you own a satellite ETF, I think you should be more concentrated. It has better performance historically. It has a better methodology. It's more intuitive. I like the fact that they only keep it for 2 years. Anything more than 2 years to me is no longer an IPO per se. I think that it's only got 350 million in assets, but that has been steadily increasing. It's had better performance, like we talked about. So overall, I think it's just better managed, better performance, and truly doing what you want it to do when you buy an IPO ETF.
Well, let's slide to you now, Mike. Who's your overall battle winner?
So I think, I'm in agreement with John here. I think IPO is a better mousetrap for capturing recent IPO issuance. And if that's what you're looking to add into your portfolio, IPO is the clear winner. It doesn't mean that it'll always outperform. Obviously, there's very different portfolios, and it doesn't mean that FPX it's got some very good stocks in it. It's a very interesting portfolio. And if it wasn't up against IPO, its performance has been fantastic. It's just that I think of ETFs as tools and expand your toolbox when you're building portfolios. And this particular tool is to expand the access to companies that you may not otherwise hold. And IPO, in my opinion, does the best job of doing that.
Excellent. Well, our judges have weighed in, and according to my battle scorecard, the winner of this showdown between IPO ETFs is the Renaissance IPO ETF. That's ticker symbol IPO. It beat its opponent in exposure strategy and performance, the mystery battle category, and then the overall category winner. Judges agreed pretty heavily in favor of IPO. So put this ETF on your radar screen. And at the very least, I think it's a good starting point, what we've given you for further research. If you want to play the IPO marketplace in a more diversified way versus playing the individual bits and pieces, trying to find that next hot stock, well, IPO is a good way to play that and at least put this again on your radar screen. And well, that does it for this episode of ETF Battles. We appreciate both of our judges weighing in and giving us their always excellent and timely analysis. Great job, John and Mike.
Thanks, Ron.
Thanks, Ron.
So which ETF battles would you like to see on the next episode? Well, give us your ticker symbols. Make sure you've got two, and be sure to post that in our comment section below. You can also find us on Twitter at ETFguide, #ETF Battles. And until next time, watch the battle before you invest.